Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
Good morning. Good morning, listeners, and welcome to Protect Your Assets. I am David Hollander, your host, and it's so great to be with you on this crisp Halloween weekend morning. As you know, Monday is Halloween, so this is our special Halloween show. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. And that's because I help my listeners sleep well at night by answering their most troubled legal or financial questions each week. And that's because I am a financial advisor and an attorney. So Monday night is Halloween. I love my treats as much as any person. In fact, I've got a real sweet tooth when it comes to dark chocolate. I just can't get away from it, even if it's just a little sliver. You know what I mean? So in honor of that special night, I started thinking about 5 tricks, not treats, that financial advisors use to dupe unknowing investors into making bad decisions with their finances. If you want to avoid getting tricked into bad investments or scammed into paying excessive fees, or even avoid getting duped by the latest fraudsters that we've come across, well, then this episode is truly for you. It's all coming up next, so keep it right here. Now, let's get started. Pretty good week in the market. Dow Jones up 5.7%. The S&P index up 4%. NASDAQ up 2.2%. And the MSCI EAFE up 4.9%. Bonds slightly up about 1.5%, and oil up 3.7%, settling at $88.19 a barrel. So where are we year to date right now? We've seen an interesting rally last couple of weeks, certainly capped off yesterday. But overall, why is the Dow and the EAFE, so forth, doing better, say, than the S&P or the NASDAQ, which is still in bear market territory? Remember, if you're down over 20%, still in a bear market. So I'm going to call this the tale of two markets. For those of you who are fans of that story. Well, the S&P 500 has been little changed when you look at it on a year-to-date basis as compared to the Dow. And why is that? Well, that's because the S&P has a pretty heavy weighting in tech. And since tech earnings have weighed on the index and the NASDAQ, as we just said, the reality is that beyond the tech sector, the performance of the market's been pretty decent. And so when you look at the performance gap, say, between the SPY, these are symbols I'm throwing off now, and the RSP, SPY, which mirrors the S&P 500 and has tech as its largest allocation, is essentially flat since Monday, while RSP, which is the equal weight version of the S&P 500, has rallied by a little over 3% over the week. And that's because earnings from traditional sectors like industrials, financials, consumer staples, well, they've been pretty good, better than feared. And so the performance right now shows an important point, which is that tech may still be vulnerable to more declines, but the more traditional parts of the economy, including sectors like low value, they're proven pretty resilient, and they're able to hold up through what we've seen has been a pretty rough market. So stepping back, this market and the economy more broadly is starting to remind me of, you may remember 2000 to 2002. We're setting up for that right now, which is, you may remember the dot-com bust, where we had extreme tech weakness, and this weighed on all the major indexes, but your more traditional parts of the market and the economy did a little better overall. So bottom line, earnings season right now is continuing to advance. We're just about through it. And if you've had overweight exposure to defensive sectors, low volatility stocks, value, and as we approach what will likely be more deterioration after the election, then I continue to think that those sectors are some of the best ways to maintain exposure in the market while still trying to protect yourself on the downside. And so if you're going to be looking at tech at all, well, maybe a dollar cost average in. There's certainly some great names out there have gotten beaten up with their earnings as they come out. It's impossible to pick the bottom. But if you look at the Russell 2000 overall, these tech-heavy NASDAQs, et cetera, are down still pretty good. Still in bear market territory. So there could be some real value there for you. Now, the next question I got, which was pretty good, is how far do I think this relief rally, which is what you could call this, is going to go? And so if you look at the market and where it closed, of course, I'll give you some technical numbers to write down and think about. So in the near term, because we just got over 39.01 on the S&P 500, in the near term, look for 39.10, and then the next one would be 4,009, and then above that would be 41.49 as levels that could see this rally that we're really in right now start to fizzle. And so there is evidence that the tradable bottom is out there. We just don't know where yet. But again, in a minute, I'll give you some things to think about there. On the downside for the S&P 500, right now, 3,500 is a pretty good support level, 3,500 to 3,600. That's the key support. And again, if something happened there, we have some problems. But overall, let's talk about the economy and economics and what's going on with inflation. Because I'm starting to see some signs that the Fed rate hike is actually helping. And so we need to see more of that for this to actually call a bottom. So right now, the housing price update. We saw this past week the Case-Shiller Home Index come out. And year over year, the index is on its way down. It's been pretty significant. So we've seen prices on homes start to fall nationally. And this isn't a reason to add stocks right now because of what I'm seeing here, as house prices are still substantially up. When you look year over year, they're still up around 13%, but the increases are going down. In other words, we're seeing a trend to start to go down. And over the next several months, what's going to happen as a result of this is it's going to put pressure on the consumer price index. Remember, that's the main catalyst that's propelled this market downward when those numbers come out and they're higher, right? Because it looks like inflation's going to be around longer. Housing is a pretty big percentage of the CPI. And since we're seeing that now start to go down, that's the first sign that inflation is declining and the economy is slowing down. So the home price data is pretty noticeable right now because it confirms that there's disinflationary forces right now that are building up in the economy. And while it'll take some time for that to show up in that CPI, it doesn't mean stocks have hit a bottom yet. But it does mean that inflation is starting to decline in the coming months and quarters. And for me, that's comforting. So what else is out there? Well, the house mortgage, right? What's driving this? I'm sure you saw the 30-year home mortgage went over 7% for the first time in 20 years. I mean, think about that. We haven't seen rates like this for a while. And so as you have these higher rates, people can't afford to go out and buy homes anymore, except for those who've got, just bank. I mean, we're seeing these outrageous prices still in Marin, where you've got these people paying over $5 million for 2,800 square foot homes. And of course, it's all cash. And you're saying, what? Really? Okay. You're still scratching your head because you're just wondering. They're not financing that. I promise you that one. What else are we seeing in the economy this past week that is showing that inflation is starting to slow down? The other index that we look at, which the Fed's looking at as well, is something called new orders for non-defense capital goods ex-aircraft. NDCGXA, to abbreviate that one. And what that is in plain English, it's a proxy for businesses spending money. And that came out this past week, and it was a pretty big miss. In fact, it fell almost 1%, where the estimate was a gain of 0.2%. So again, we're seeing these numbers miss expectations, and that's a good thing when you're starting to think about inflation turning around, because what it basically says is that businesses may finally be pulling back on investment and spending, and that's a negative for the economy. That says that the economy is slowing down, and the Fed is having an impact with all these rate hikes that they've been doing, and that perhaps this quantitative tightening that the Fed's been doing is starting to cool down a little bit. I don't expect it to slow down. I expect them to keep raising rates these next two turns, but we've got November coming up, then December, and they won't come back until March of next year. So again, I think as you look at this market overall and how long this could go, because that's what everybody wants to know, I think it's going to be 6 to 8 months at a minimum till we start to see that. So we got election coming up. Maybe we'll see some cooling going on. Overall, like I said, I think the S&P 500, which again is the broad index, I think that's got some more downward in it. How far down? It really depends on if we violate these support levels and there's momentum and there's bad news. That's really what's out there. And so again, if you see 3,400 in the S&P, don't be surprised. Again, that's a pretty big move from where we are today because we just went over 3,900. But I don't really see it going much above 4,000 to 4,100 on the upside. So that's sort of your range if you're, looking at that sort of thing. But again, I encourage you to be a longer term investor and allocate your portfolio. And if you do that, you could see even through a year like this where it's been pretty tough for bond stocks, etc. Should have done much better than your friends who say we're all in tech or all in international, etc. And so the other index too that I look at a lot, this is interesting on the income, bonds, et cetera, like that. I talk a lot about the 10-2 spread, meaning the 2-year treasury as it relates to the 10-year treasury and how the 2-year is paying more interest than the 10-year. It's called inversion, and that still sits around 39 basis points, which is 0.39, less than 1%, less than 0.5 of 1%. But that spread has been getting more attention this week because the 3-month, which is the 3-month versus the 10-year, has also inverted recently, which historically the 3-month versus the 10-year is a better and more timely recession indicator. And the inversion of that, which just occurred, solidifies the expectation that a recession will be coming within the next 12 months. Now, I've been saying we're in a recession now. I think we still are. And of course, they're not calling it yet. And I think once they call it, it's too late. But right now, treasuries right now are confirming the sign of a bottom across the yield curve. And why you should care about that is if you're buying fixed income right now, even short-term fixed income, this might be the time to lock in those higher rates. Because again, once that bottom's reached, it's over. And rates will start to go down again on your fixed income, and then you've sort of lost out on that. So when I come back, account takeover fraud. Now that we're living in a digital reality, how easy is it for you to get ripped off out of your bank account? Well, I'll tell you what the latest scam is when we come back. You're listening to The Sandman on the Protect Your Assets Radio Network. We'll be right back.
David Hollander.
Something weird and it don't look good. Who you gonna call?
David Hollander. Welcome back to Protect Your Assets with David Hollander. Do you dream of a successful retirement? Let the Sandman and his team guide you towards a smart retirement. Now, back to Protect Your Assets with David Hollander.
Here's Johnny.
Welcome back. I am David Hollander, also known around here as the Sandman. And you are listening right now to Protect Your Assets. And Monday night is Halloween. So this is our Halloween show we do every year. I love seeing all the kids of all ages. The 16-year-old awkward in the suit that doesn't fit. And the 3-year-old who's excitingly coming to your door and hoping for a big, giant candy bar. as they ring your doorbell and say, trick or treat. So with this theme in mind, I want to help you uncover some of the top tricks financial advisors and institutions are using right now. So hopefully you can avoid them like the neighbor who gives out the apples and toothbrushes. If you've wondered about bad investments, excessive fees, or getting duped by fraudsters, then this episode of Protect Your Assets is designed just for you because we've identified 5 of the latest tricks, not treats, that financial advisors and institutions are using to trick you out of your hard-earned money. So the first trick, not treat, that's going on right now that some institutions are a part of, even unknowingly, is something known as account takeover fraud. I don't know if you've heard of this, but basically after COVID, the financial services industry has quickly moved to virtual and online consulting. And so whether you're Zooming or just logging into your account via an app on your phone, you got to be careful, like really careful. And so we're seeing an area right now of what's known as account takeover fraud. So let's talk about this. First of all, Nicole B., we're going to call her. She's a 54-year-old art teacher, as recommended, which we're saying you should do. She did a routine check of her 3 linked bank accounts online recently with a big, very well-known national bank. She noticed something alarming. $10,000 was missing out of her account. And so the art teacher looked closer to find that $9,300 had been removed from her business account and $700 from her personal checking account. And they had been transferred to a 4th account in her name that she never opened. Now, this happened through cyber security or cyber criminal that was out there who was tracking her. So according to this Javelin Strategy and Research report, there was a 90%, think about that, 90% increase in this thing called account takeover fraud. And this is when a criminal opens an account in your name. And total losses from this identity fraud and scams, get this, totaled $52 billion and affected 42 million consumers in the United States. So chip technology has made it more difficult to make counterfeit credit cards. Remember in the old days, that was a way they could just scan your credit card and then knock that off. But now because of the chips, it's impossible or virtually difficult to do that. So criminals right now are essentially stealing you, stealing the person, meaning your identity instead of the card. And then they use this identity theft to, among other things, open up banks accounts in your name and then steal the money. And because these thieves generally have built up more savings than their younger counterparts, again, the ones who are the older savers, 50 years and older, then you become the target. So how do the criminals, first of all, access your account and what can you do about it? Well, first, there's a reason that choosing a smart password and then using a different one for each of your accounts is one of the top rules that we're going to talk about. Websites are frequently hacked, compromising sometimes millions of passwords. As you may remember with LinkedIn last year, there was a data breach where the personal information of 700 million users was taken. And so once stolen, the username and passwords are often sold on underground markets to these cyber criminals who can then test them on bank login pages. So criminals know that many people use the same or similar passwords across dozens of accounts. Every time I talk to someone who this has happened to, I hear the same story when I ask them, is your pet store account password the same as your Citi account? Same as your coffee shop account? And so you hear, well, yeah, or people will say, well, for the coffee shop, I use Fido123, but for Citi, I use Fido321. The modern tools right now that these criminals have can hack through that sort of thing in a matter of seconds. Criminals will also send phishing emails to you. I mean, these most of the people that I know that run businesses get these all the time. And so they'll advertise a product or telling you you've won something. And with a link, you click it, and this affects your computer or your cell phone with malware that makes it easy for these criminals then to harvest all of your saved-in credentials, or even mirror mask you to the people you've talked to and say, well, can you send me money, or can you help me with this or that? And these people think it's you. So, if you just be careful, if you're asked maybe to give identifying information about yourself through a quiz, an online quiz or something like that, you need to be careful, because the more information they have about you, the easier it is for them to impersonate you, then access your account, and the bank won't flag it because it's not suspicious, because they know things about you. So how can you prevent this? Well, the best way to protect your money is, first, never reuse passwords. So don't use the same password on every single site, particularly if you're one of the many who opt for the simple 1, 2, 3, 4, 5, 6 and the word password. Seriously, people still do that. These are some of the most commonly used passwords out there, according to NordPass. Use unique long pass phrases. You're not going to like this. 40 plus characters for each. And subscribe to a password manager like LastPass or Keeper to store them all. Next, there's a company out there called Darktrace you might want to check out, where it'll protect you from the latest sort of scams that are going on, or put a AI on your access, so then it acts like a intelligent blocker and sees what's going on and tries to stop it before it happens. I recommend to have a single very strong and memorable passphrase for your password manager. Choose something that's relevant to you, but also as random as possible. Second, use a unique username. If you don't have to use your email address as your username, then don't do it. It's that simple, because they know your email. Third, set up a multi-factor authentication on your account, known as an MFA. Many banks right now and financial institutions are increasingly using these MFAs, and this adds an extra layer of security on your account. You're going to have to log in using your username and password, but then you're prompted to get to the next level through a second stage of verification that usually is a text that's sent for 10 or 30 seconds to your cell phone that you then have to use to log in. Also, many of these now have what's called facial recognition. This is another type of MFA that can be used to verify you as the person who you say you are. Fourth, check your accounts frequently. If you notice any irregular charges or activity, call your bank immediately. Keep an eye out for very small transactions, such as $1 or 5 cents, because criminals do this to test to see if the transaction goes through, and then they steal a much larger amount. Fifth, set up alerts for every transaction made. A lot of financial institutions have this feature, allowing you to immediately identify suspicious transactions, which is crucial because essentially view yourself in partnership with your bank. You need to be active here because the criminals are out there hunting for you. Are you dreaming of retiring early? Well, if you are, it's time to find out if you're ready. I have a quick checklist that you can go through after you talk to one of my people. So pick up the phone right now, and that way you know it's coming from you, not us. Pick up the phone right now. Call this number, 866-PROTECT. Again, the phone number is 866-776-8328. Pick up the phone right now. I have this quick checklist for you right now, which can see if you are prepared to retirement. Happy to send that out to you right now at no cost. Pick up the phone and call us, 866-PROTECT. When I come back, it's time for our popular They Say segment, where they say they have a competitive advantage with their proprietary fund, and you can't get it anywhere else, so you have to buy it. Should you? Find out. You don't want to miss this one. You're listening to Protect Your Assets with David Hollander. That's me. I'm the Sandman. We'll be right back.
It's close to midnight. Something evil's lurking in the dark. Under the moonlight,
You can ask the Sandman questions and hear this show Protect Your Assets hands-free anytime on your Amazon Echo smart speaker. Just say, Alexa, ask Protect Your Assets to play the latest podcast. Find out more at libertygroupllc.com/voice. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, known as the Sandman. And I don't know about you, but that Thriller video is still one of the best ever. You got to go back and watch that if you missed it. Monday night is Halloween. And as a result of that, we are doing our Halloween show today. And I hope you have a great Halloween Monday as the kids come to your door and ring the doorbell. And it's so much fun to see them, isn't it? And see the excitement in their eyes and their costumes. I just love seeing that. With this theme in mind, I wanted to help you uncover some of the top tricks that are going on right now from fraudsters as it results to your financial life, and some of the other scams, if you will, that some of the financial advisors out there are using to separate you from your money. If you've wondered about bad investments, excessive fees, or getting duped by fraudsters, then this episode of Protect Your Assets is designed just for you. Now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? There's only one man with all the answers, and here he is, David Hollander, the Sandman.
So here's one they say. They say they have a competitive advantage with their proprietary fund, and you can't get it anywhere else, so you should buy it or hang on to it, but you definitely don't want to sell it, right? Well, yeah, you know the answer to that one. It really does depend, because on balance, as you start to dig into these sort of things, the result is there's a huge conflict of interest. What do I mean by that? Well, this trick, if you will, in the financial service industry creates a pretty big conflict when you place the interest of advisors as it comes to fees above yours. And so this is something that's known in the industry as revenue sharing. This is a practice where a mutual fund company or an insurance company would pay the advisor an additional fee, also known as an incentive fee, to push a particular product instead of other possibly better performing ones that exist out there. These are, if you will, backhanded deals that can line the pockets of advisors and the companies that they work with in a pretty big way. Take this example. According to a revenue sharing disclosure released by a company, this company stated that they received revenue sharing payments of approximately $186.7 million from mutual fund and 529 product partners and $7.7 million from annuity partners. For that same period, the same firm said their net income was $746 million. So when you just do the math on that, 25% of this firm's income that year was coming from selling you products that offer the firm or the advisor an additional kickback to promote those funds. 25%. So what does this mean? Well, it means it's going to probably be more expensive to you. And overall, when you compare it to other options that are out there, lower performing. I've also heard of clients say that their advisor said these investments were proprietary and were only created for this particular firm and their clients. So do you think these advisors are only showing you those funds because they're getting paid a little bit more? How do you really know? If you want to find out, we can perform an X-ray of that fund to see if you're being overcharged. If you want to know that right now, pick up the phone and talk to Adrian or Phil. They're back there right now answering the phone. 866-PROTECT Just give them the name of that fund. Make sure you call us, right? We're not calling you. You call us, 866-PROTECT, and you say, hey, I got this XY. What's going on there? All right. The next trick that I'm seeing a lot of right now has to do with bonds and fixed income. Because right now, with rates being pretty high on fixed income across the board, I'm seeing a lot of folks looking at different rates. So we frequently hear on a weekly basis, hey, I'm getting this from the CD over here, or this from this bank over here, or my bonds are showing this. And they say to us, what are the real rates out there right now? What are you guys seeing? And so we're more than happy to look at our bond desk and see where different rates are trading right now. I'll give you some examples, like on, say, the 3-month or the 6-month Treasury note. We're comparing those to what you're seeing from your banks or your other advisors. And in a lot of cases, we're getting higher yields than they are. And you may say, well, why is that? We're looking at essentially the same market, aren't we? Well, no. So here's where something goes on that you may not be aware of. If you're talking to a broker instead of a investment advisor, there is a difference. Investment advisors are fiduciaries, which means that they quote you the rates that they're seeing on their system, net of all fees, because you pay a separate fee, usually either an hourly fee or a percentage of the assets under management, and you know what that is. That's disclosed to you before you get involved in the investment. On the brokerage side, this is where a lot of people say, well, I'm not paying anybody anything. Really? Are you sure about that? They don't work for free, these people. How do you think they, pay their bills? So this practice that goes on in brokerage is where they add fees to the yield. So if you call me and you see that we have a 1 year paying, X, and you call your normal broker and they say it's Y and it's lower than ours, and you may say, well, why is that? It's because they're padding that spread. In other words, they're putting commission into that trade. That's how they're getting paid. And then your yield is less because after fees, that's it. This might be important, particularly if you're short-term trading bonds right now, because as you know, bonds have gone down a lot in value as rates have risen. And so you may be thinking about trading in or out of bonds over, say, the next 6 to 12 months as things sort of shake out here with the government, with the Treasury, and with inflation. All these things are moving right now pretty severely. As I mentioned at the top of the hour, the bond market right now, index is off 14.9% year to date. So consider that. I mean, you look at the Dow, which is off 9.6% year to date. You have bonds, which traditionally are more conservative than stocks, off more than 5% year to date than the Dow Jones stock market, right? So bonds are supposed to be safe, right? Wrong. There's your proof right there. So I have a question for you. When was the last time the person you go to for investment advice reviewed your tax return? According to Kiplinger magazine, says the right advisor for you and your money is one that is a quarterback, a team of professionals who reviews your tax return on a regular basis to make sure your investment plan is tax efficient. And if you say, well, my advisor's never done that, then we're going to count this as one of the 5 tricks, not treats, that financial advisors are using right now, because this lack of tax coordination keeps you farther from achieving your goals because they're just not looking at it. It is dreadful to think that any advisor would give you advice without first reviewing your tax situation, or at least asking you about it, but it happens all the time if you think about it. So that's one reason we stand out from other advisors, because we like to talk to you about your taxes. In fact, we have CPAs in our office who review your taxes if you let us do that, who will look at your investments from a tax efficient standpoint. Particularly right now as we're sitting here, it's October, late October, right? And you've got a couple more months before the end of the year, and then it's too late. So right now is the time, particularly when investments are down overall, might be a good time to do some trading into other indexes which are similarly linked, but at least you can get the deduction for the loss now before it's too late. So if you're not looking at your taxes right now, well, don't wait till December 31st, because then it'll be too late. Do something about it right now and stop paying more in taxes than you really need to. Call us and speak to a member of our tax team to keep more of your hard-earned money. And you can do that right now by picking up the phone and dialing this number, 866-PROTECT. Again, 866-776-8328. Many of our clients pay less in taxes and save more. What are you waiting for? Lines are open. Call 866-PROTECT and find out what you're missing out on. Coming up next, find out how one of the nation's largest advisors said you can take out 7% per year from your account and not run into any problems. Find out how one family almost lost everything sticking with that advice during this bear market. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Here's Johnny.
Welcome back. I'm David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. And Monday is Halloween, so today is our Halloween-themed episode. I hope you've enjoyed it. We've been helping you protect yourself from some truly ghastly financial advice and practices that are going on out there. So this morning we've been talking about the 5 tricks, not treats, that financial institutions and advisors are using to separate you from your hard-earned money if you want to avoid getting tricked into bad investments, scammed into paying excessive fees, and avoiding getting duped by fraudsters. Then this episode is designed just for you. And that reminds me, if you missed any of it, particularly the market segment. A lot of people have a lot of questions right now about the stock market. How much longer will this bear market grind on? I know we've had a little bit of a rally here, but how much higher can it go? And how much lower do I think it will go in, say, the next 6 to 8 months? What do you need to know right now? If you missed it, you can listen to our market segment where you listen to podcasts. So Spotify's out there, iTunes, just go there, click on the hourglass, type in Protect Your Assets. And when you do that, you will see something called my market segment. There's actually a rendition of myself when I had more darker hair. And you will see the market segment where we talk about it. So it'll be posted tomorrow. And if you want to know what's going on next week or what just happened, check it out. If you like it too, please tell your friends, because that really means a lot to me and I appreciate it. Today, we've uncovered some pretty horrifying sale practices out there when it comes to financial advice. The first one, which was called account takeover fraud. This is a new one that's literally taking money out of your bank account and putting it into somebody else's before you know it happened. Also, higher fees that are out there through revenue sharing, where companies and advisors are incentivized to peddle specific funds that pay them more. We also discussed how important it is to work with a wealth advisor who coordinates your investment plan with your tax plan by monitoring your taxes each year and planning accordingly. That leads me to the 5th and final trick that we've come across. You've probably seen the commercial. Regular looking guy or gal, nice office. They're on your side because they make more money if you do, and they don't, if their account's going down, they make less. They have a really great marketing department. Let's face it, you see them all over the place. They say they're all about lower fees and helping you. But if you really take a look at it, I don't know if that's true. Because if they're telling you right now to take out 7% of your portfolio to live off of, and the performance will do the rest, well, how are you doing right now? How much have you gone down year to date? Take a look at that number and compare it to other indexes out there, because we came across a family who had retired, sold their business, and they went with this group, and they were told to take 7% out of their portfolio each year to live on, and the market would do the rest. Well, along came the 22 bear market, and this has been a long one, and if you go listen to my market segment, I say it's going to go on for longer. So when you do 7% out and the portfolio, say, down 50% or more, those withdrawals start to become a real problem. And the reason that is because as the portfolio goes down, it takes some serious returns to get it back, especially when you're living off of it. So right now we're seeing a lot of volatility in this bear market, pretty much across the board. Bonds are down, stocks are down. And even though we had a little bit of a relief rally here, I don't think it's over. And so after the election is behind us and things start to settle down and companies continue to slow down, revenue profits start to slow down, interest rates settle in, the real estate market's slowing down, interest rates are high, the word recession will start to float around. Again, these are my predictions, but I think we're in one right now. And I think that R word's going to float around, and you need to be careful about how you withdraw money out of your account if you need it to live on right now or if you're retired. Because you don't want to be retired thinking everything is fine and then being told you need to change your lifestyle dramatically if you don't want to outlive your money. Do you? Well, think about it, because the 2018 tax rules are going to go away in about 2 years, and right now you need to do something about it before it's too late. So we have an analysis prepared for you right now through this bear market. We'll call it a crisis call, 15-minute crisis call. You can do it right now. Get a second opinion from a fiduciary. Call this number, 866-PROTECT. Pick up the phone, talk to Adrian or Phil right now, 866-PROTECT. They're back there waiting to talk to you, 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer and network manager, Kevin Renfer, and of course, all my fabulous producers back there doing all the heavy lifting. We got Sean, Adrian, Phil. Because without my team, hey, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.